Another set of formulas that cost accountants can use to make assumptions and predictions about what their potential profitability is going to be is CVP analysis. And the big thing for CVP analysis is being able to identify your contribution margin. What is it? It's the top part of this formula right down here. It is your revenue minus your variable costs. So your total contribution margin is all the revenues you expect to generate minus all the variable costs you expect to incur to generate those revenues, all your material costs, labor costs, and variable overhead costs. On the unit level, it's the sales price per unit minus the amount of materials, labor, and variable overhead that go into each unit. But knowing your contribution margin lets you know how much profitability is going to be left over from each unit sold that is there to contribute, why they call it the contribution margin, towards covering your fixed costs. So if you want a desired level of operating income, most important step there is the top end of this, knowing what your contribution margin per unit is. And for this, for CVP analysis, you're going to need to break down a whole bunch of things to determine exactly what you want to get to, which is usually your operating income. You're going to be looking for a target level of profitability. And to determine your target level of profitability, you're going to need to know what you're going to intend to sell each unit for, your sales price per unit, what amount of materials, labor, variable overhead, selling costs, etc., go into each unit, your variable cost per unit, your expected volume, or you might be determining your expected volume, um, how many units you expect to produce and sell during the period, and what amount of fixed cost you have to cover. And you can use this to answer a variety of questions. You just solve for different variables within the formula. Like, what is the company's profit or loss going to be if we can only move a given volume of units? CVP would be able to tell you that. How will changes in product inputs, and by that I mean like material cost or the time it takes to produce a unit, etc., affect your profitability? How many additional units must be sold to increase operating income by a set percentage? And for bigger questions here, what if you have a shift in, as they call it, your cost structure? Things become variable or fixed or vice versa. So if you have a bunch of laborers that are making stuff by hand and they're getting paid hourly, that would be a variable cost. Whereas if you find a machine that you can buy that will replace some of those laborers and you lease that machine, the lease cost of that machine becomes fixed. So how does changing your cost structure affect your profitability? All things that CVP can answer. So while this is going to look like a different set of formulas, it's still an extension of regression analysis. If you're looking for a level of profit, and there's no numbers down here, but it could just be any arbitrary point, like say right here in the middle right there. What you're really doing is solving for the amount of revenue that you need to generate. You're solving for the amount of cost you're going to incur to move that volume of units down here. And at what volume do you need to have your profits triangle, if you will, be that big? And this one is a very important spot where these two regression lines intersect. The revenue line is your total revenues go up as your volume increases, or your cost line, when those two spots intersect, is where revenues equal costs exactly. And they call that the break-even point. So the break-even point, if you want to look at it in a simpler formula, instead of having the two regression analysis lines, you can just have it be the point where your total contribution margin and your fixed costs are going to be exactly the same. Because if your margin that's there to contribute towards covering your fixed costs is the same exact amount as your fixed costs, you'll have nothing left in terms of profitability afterwards. So put this in example, some numbers to work with so we can conceptualize this. We're going to be Man's Best Friend Incorporated, and we sell dog beds. We sold 10,000 dog beds last year, and the breakdown of how we got there is down on the bottom. We sold 10,000 beds at $50 a piece, therefore generating $500,000 in sales revenue. The variable cost incurred to manufacture each one of those beds that we sold was 10 bucks. So the 10,000 beds at $10 a piece cost us 100,000. What was therefore our contribution margin on each unit sold and our total contribution margin? Well, if we're selling for 50 and we're only paying $10 in variable costs, that means that after we recoup that $10 to cover the variable costs, we have $40 left over from that selling price, which can contribute towards covering the fixed cost. And that's on every unit. So it's 40 units at 10,000 bed or $40 at each bed for 10,000 beds. That's $400,000 in total margin that we would have. Our fixed costs are 160,000 and would not change because of volume. If we wanted to spread those fixed costs out and try to estimate what amount of fixed costs we incurred for each unit that we produced, well, we take that 160,000 to see that we sold 10,000 beds. 160,000 divided by 10,000 is an assumption of $16 in fixed costs that we have to pay for each unit produced. And if we had $40 towards covering the fixed cost for each unit produced, and that fixed cost was 16 bucks, we'd be making $24 in operating income off of each unit. If you want to look at the bigger picture, if we generate a total margin of 400,000, we have to cover $160,000 of fixed costs out of it. We've got 240,000 left over. A number that is very important that's on the chart over here is this 80%. What is that? That is our contribution margin percentage. It's the percent of every sales dollar we have that ends up being contribution margin. If we're generating $500,000 worth of revenue and it's leading to $400,000 worth of margin, well, 400,000 divided by 500,000 gives you that 80%. And we can use that 80% to figure out target levels of revenue that we're going to need to get to a level of operating income we want to have. So for our company over here, we had $160,000 in fixed costs. What is our break-even point? Well, our break-even point is how many units we have to move to cover those fixed costs exactly. And for us, we're going to need to figure out what is the margin that we generate off of each unit, which we have here. It was $40. So if we're generating $40 off of each unit, how many units do we have to sell in order to come up with $160,000 of total margin to cover our fixed costs on the dollar? Just take your fixed costs and divide it by your unit's contribution margin. $160,000 needed, making $40 off of each unit. 160,000 divided by 40 is 4,000 units. So our company over here, Man's Best Friend Incorporated, despite the fact that we were profitable right now, we're looking to see, okay, what if sales decline? Like, what is the point where we'll start incurring a loss on these dog beds if we don't sell more than that? And the answer is right here. 4,000 units is exactly what you need to cover your fixed costs. You won't make any money, but you won't lose any money. That is your break-even point in terms of units. You can also tell, and there's a typo on the slide right here, your break-even point in terms of sales dollars. To do that, you take your fixed costs and you divide by your contribution margin ratio, the contribution margin percentage. We know from going back a couple slides here, sorry if I'm making you dizzy, we know that 80% of every sales dollar ends up as margin. So what we're really asking ourselves is we need to cover $160,000 worth of fixed costs. And 80% of every sales dollar ends up as is contribution margin to cover those fixed costs. So what number is 160,000, 80% up? Or yeah, what number is 160,000, 80% up? Well, you'd find it by taking your fixed costs, dividing it by your percentage, and that gives you the number. And it'd be $200,000 in this case. If we generate $200,000 in revenue, we have enough to cover our fixed costs, leaving us $160,000 in margin, which is 80% of that 200,000. And that covers our fixed costs exactly, giving us a total operating income of zero, our break-even point. One thing you can always do to check yourself when you're working both of these formulas is your break-even point in terms of sales dollars should always be equal to your break-even point in units times how much you sell each unit for. So our break-even point in units was 4,000 units. We sell each one of these dog beds for $50 a piece. So if we sell 4,000 units at $50 a piece, that gives us $200,000 in sales revenue. All of our numbers jibe right here. That is what we need to do to get to break-even levels of profitability. But no one ever wants to just break even. You want to turn a profit. Well, what would you do there? If you want to have enough money to cover your fixed costs and have X amount of profit left over, well, those two together in the parentheses up here is the total required contribution margin you need. And if you take the total margin that you need and you divide it by how much margin you make off each unit, it gives you the number of units that you need. So in this case, instead of breaking even, what if MBF wanted to make $300,000 in operating income? You take your $160,000 in fixed costs, add to it your $300,000 of target profit, that's $460,000. And if you divide the $460,000 total required contribution margin that you have to have by the $40 you make off of each bed sold, that's 11,500. So backing up over here, we have, sorry, wrong way. We had $240,000 worth of income from the sale of this particular product. Somebody in the company said, how many units are we going to have to move, assuming that all of our costs and sales price and everything stays the same? How many units are we going to have to move to increase that to 300 grand? You'd be like, and you'd go and solve it. And right here is the answer. 11,500. So we are selling 10,000 before. We need to increase sales by 1,500 to increase our profitability to that target level. If you want to find this same thing in terms of sales revenue needed that leads you to a certain target profit, you use the same formula, but you just divide by your contribution margin ratio. We need $460,000 in total required margin. We know that 80% of every sales dollar ends up as margin. So we're asking ourselves, what number is 460,000 80% of? Well, you take the 460,000, divide by 80%, and you come up with 575 grand. We need to do $575,000 in sales revenue to be able to cover that's 20% variable cost, if you will, leaving us with enough to pay our $160,000 in fixed costs and have $300,000 in profitability left over. One thing with CVP is it solves for operating income. And operating income isn't your bottom line income because you need to solve for taxes. You have to pay taxes too. So if someone said to you, like, "Well, how many units do we have to move to have net income of a certain amount? Not pre-tax operating income, but after-tax bottom line net profit for the company. How many units would we have to move?" Well, you first have to convert your target net income into how much operating income you're going to have to be left over with that net income after you pay your taxes. Formula's a little confusing over here. Just focus on this chunk over here. What you're going to do is you're going to take that target level of net income, bottom line profit that you're looking for, and you're going to divide it by the complement of your tax rate. We pay 40% taxes, which means we get to keep 60% of our operating income, which is what this will solve down here. To convert net income to operating income, we were basically asking, okay, the $300,000 that we're going to have left over, we know is 60% of our pre-tax income. What number is 300,000 60% of? And that becomes the 500,000 down here. And now you've converted your after-tax income into pre-tax operating income. And you can solve the formula as we did before. Add together your fixed costs and your target level of profitability, and then divide by your margin per unit, and it gives you your cost. So if we want to have $300,000 not of pre-tax operating income, but of post-tax net income, we have to move more units. And that answer is 16,500 beds would have to be sold for this company to have $300,000 left over as bottom line profit after they paid all of their costs. Same thing is true for the contribution margin ratio, and it's the same steps. And essentially what you're doing over here is the same thing, but you're just dividing instead by the unit contribution margin in terms of dollars, you're dividing by the contribution margin ratio. So over here, we would have 300,000 divided by the complement of our 40% tax rate. And we know that to be already $500,000, $160,000 of fixed costs, $500,000 of pre-tax income after we solve for this portion of the formula, leads us to $660,000 of operating income that we're going to have. Well, what number is $660,000 80% of? Divide by 80%, and that answer is 825,000. Another way that this can be expressed after you've gone through and found your break-even point is your margin of safety. And it's basically a measure of how much can sales change on a particular product or revenues from a particular segment, if you will, before we start losing money. And all it is your current sales volume. So we're backing up a bunch of slides here, but we actually sold 10,000 beds during the period. If somebody said to you, market's not looking great right now. We don't think we're going to sell as many units. We might lose money on this. How safe are we before we start having this be an unprofitable product? Well, you'd solve for your break-even point, which we've already done for these dog beds. We know it to be 4,000. That's the point where you don't make any money, but you don't lose any money. And your margin of safety in terms of units is how much excess you have above that break-even point in your current sales. If we're selling 10,000 units and we know 4,000 is the point where we'd start losing money, we can have sales decline by a whopping 6,000 units before we actually start losing money. In terms of revenues, it's the same concept. You just solve for your CVP formula for your break-even point in terms of revenues instead of in terms of units. We did that already. We know it to be 200,000. Those 10,000 beds that we actually sold, we sold for $50 a piece, generating $500,000 in revenues. Well, we know that 200,000 is the amount of break-even revenue that we need to generate from sales to cover our variable costs and our fixed costs exactly, uh, without losing any money. So if we can get by without losing money with only $200,000 in sales, but we're doing $500,000 in sales right now, sales can decline by $300,000. Our margin of safety in terms of revenue on this particular product is 300 grand. And they have the margin of safety ratio. You can use it in other formulas you may see later in your accounting classes, but it's just a different way to express the same thing that we're talking about. By what percent can your sales decline before you start losing money on a particular product? Well, we know that sales can decline by 6,000 units, and we're currently selling 10,000 units. So it just expresses a percentage. 6,000 units is 60% of the 10,000 units that we are currently moving. We're going to have sales decline by 60% on this particular product before it starts becoming unprofitable. The market would have to be exponentially bad to cut our sales in more than half. So I highly doubt that that is a plausible situation. This product for this particular company is looking like it is a pretty safe thing to continue doing during the next period. And you probably don't want to be discontinuing this, at least if unless you have an option for something that would be much more profitable that's going to need your production capacity. So one last thing of grand importance here is cost structure. All of these formulas are incredibly dependent on knowing which of your costs are variable, which costs are fixed, and which ones could even be mixed in this case. And there is no complete rule of thumb that for every single company that exists, that particular cost component is always going to be variable, or that cost component is always going to be fixed. You have the option to structure your costs in any way that you see fit for a lot of different items. And doing so changes your potential profitability. So, how would this happen? Like in practice, how could you take a variable cost and turn it into a fixed cost? The salary of your employees. If you pay them hourly, that's a variable cost. They work more hours, you pay them more. You work less hours, you pay them less. Whereas if they're on a fixed salary, you're obligated, excuse me, to pay them the same amount every period. So if you had a bunch of hourly employees and you're like, oh, you guys are going on salary, now all of a sudden your variable cost became a fixed cost. Other options that you can have in here is think about advertising. So most of the time, advertising is a fixed thing. You call up an advertising firm, they make you a series of YouTube ads or whatever, and this costs you 200 grand, and that's a very fixed amount. But that's not necessarily true. Sometimes advertisers will have a contract where it's based on some kind of performance metric. They'll make a deal with you that like, yeah, we'll make this thing for you, and for every additional unit you sold over the last period that you had, we want to keep 10 cents of each sales unit. Well, now that structure of your marketing contract turns it from a fixed cost into a variable cost. It'll go up and down with the volume of sales that you do. And there's more things on top of that. Manufacturing capacity, if that's the case. If you don't have enough hours in the day and time to produce all the units you need to do, you need to expand your capacity. Well, you could rent another facility and you could lease new machines and you could expand your capacity by having more ability to produce. And both of those things I just talked about, rent and lease, those are fixed costs. So you have a fixed structure of increasing your capacity. But the other option is saying, hey, this is the building we have, these are the machines we have. we're only working 8 hours a day. How about everybody works 12 hours a day? And now increasing your production capacity turned into paying your existing workers in your existing production space overtime. And that becomes a variable cost because as overtime increases or decreases, the total amount that you're going to, sorry, the number of hours of overtime they have to work increase or decrease, the total amount you're going to have to pay for labor and to produce goods goes up and down. Whereas if you rent another facility and lease machines, that becomes a very fixed amount. So cost structuring will change your formula as it's going through because it's always the same thing. You want to have enough margin to cover your fixed costs. Well, turning something from variable into fixed will um, increase your margin on each unit. You have less variable costs to cover, but it also will require you in the end to cover more fixed costs. So cost structure is an incredibly important thing. As a rule of thumb in cost structure, the more variable cost heavy that your structure is, the more safety that you have. Because if people aren't buying stuff, well, you can tell your workers not to work and you stop buying materials and you don't advertise it because you don't think it's going to sell all the stuff. They're variable costs that you can get out of and you don't run the risk of losing a ton of money. The problem is if sales are outstanding of that particular product, well, now you have to pay all those people that overtime and stuff I was talking about. So your costs get much, much higher. Whereas if you have a very fixed cost heavy structure, you are agreeing to that certain amount that's in there. If your sales are awful and you don't want to do this anymore, you're stuck. You agreed to lease that machinery. You agreed to rent that place. You have to pay it. Your loss is going to be bigger than if it was variable heavy and you could get out of those variable costs. The upside of it is if you have all your employees working on salary, no bonus for overtime, and you want to increase production capacity and you tell them that they got to work overtime, you don't have to pay them anything extra. So your margin actually gets better on every unit that you produce. So cost structure definitely plays into decisions that you're going to make, and it is incredibly important to know which costs you have are fixed, which costs you have are variable, because you want to uh, have very good knowledge of that to successfully use CVP analysis.